Hey, I just wanted to drop this quick video to answer a question that I get asked all the time. Just recently, a friend of mine that was a realtor asked me, what's the time frame that a person can get their credit pulled and it not hurt their credit when they're shopping for a mortgage? So, you shop at, let's say they go to Quicken and then they go to Chase. How long do they have to get their credit pulled? Now, many of us already know that there is a window for where you can go mortgage shopping where if you get your credit pulled multiple times within that window, it only counts as one credit pull. And the short answer for how long that window is 14 days. That's the safe answer that you can give your clients if they're just looking for a quick answer. Is you can just say, hey, you can get your credit pulled as many times as you want to in the next 14 days by mortgage lenders. This doesn't count for credit cards and cars and stuff like that, just mortgage lenders. A 14-day period, you can get it pulled and have no impact beyond one credit pull. But there's also some information out there where people say that you have 45 days, which is not entirely wrong, but here's how it really breaks down. So the 45-day time frame is the new FICO 8 scoring system. The FICO 8 is the most recent FICO score that many creditors use, but not the mortgage industry. We use the FICO 5, the FICO 2, and the FICO 4, depending on which credit bureau you're pulling. And we pull all three. So that means we're using all three of those scoring systems. And all of those have the 14-day window. So that is the true real answer is 14 days. Now, if they get pulled on day 1, day 12, day 30, day 40, that's not going to impact their credit for going to get other things that are not mortgages. But any of those credit pulls that was beyond day 14 will start to lower the score once they get past that 14. And it's not going to be this huge impact. You're talking about a couple points per pull. But obviously, if you get it pulled 15 different times, you can be looking at a 30-point drop in the credit score, which can be a big deal. So basically, that's what you tell your clients, the 14 days. Now, here's the reason why it's really not something to worry about. When you get your credit pulled, as a lender, that credit report is good for us for 4 months, 120 days. So even if you got your credit pulled on day 2 and then later went out and got it pulled on day 45, and you come back to me and say, no, I want my original mortgage, I don't have to say, no, we got to use your new credit score that went down 10 points on day 45 because you got your credit pulled so many times. I can use that original credit report. Now, there may be some complicating factors if for some reason down the line we have to repull or something like that. That could cause an issue. But for the most part, we're using that original credit report to determine what your score is and determine your pricing and eligibility and all that other stuff. So if you guys have any other questions about, credit pulls or credit in general, I look at hundreds of credit reports on probably a monthly basis. I'd be happy to answer them for you. Shoot me a text, give me a call, whatever. I'm here. I'll talk to you later.